Hey, welcome back to Two Super Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And today we're going to talk about how Dylan's favorite trade, the opposite of the Michael Burry trade, is coming more and more into favor as the US economy kind of gets a little cooled off, and the jobs and kind of credit rating downgrade by Fitch can have a major impact upon making this entry more attractive. That will get to it.
Two Super Guys Trade Stocks.
This
All
is
right.
big news this week.
Huge news. And for people who don't know, TLT and Nikola are the reason why I have money. So this is very exciting for me because I've been waiting, timing TLT for a while. I'm like, it's still not there. Ooh, we're right there. So we're going to talk about it and what this credit rating means, if TLT is still safe, and overall what the expectations are. So Fitch, which is a credit rating company, there's three of them, I believe, Fitch, Moody, S&P. They downgraded the US credit rating, their ability to pay their bills, from AAA to AA+, right? They said the expected fiscal deterioration over the next 3 years and high growing general government debt burden and the erosion of governance, that part's important, relative to AA and AAA-related peers over the last 2 decades has manifested in repeated debt limit standoffs and last-minute resolutions. That's super true. We wait till the last second to fix any of our shit.
Everything.
And then, yeah, pretty much. Then he's like, look, not he, but them, a steady deterioration in standards of governance over the last 20 years, not because of the last debt ceiling negotiation, but just 20 years, all right? The really funny part of this is, if you guys have time, you just Google Republican reaction or Democrat reaction, like CNN or Fox articles on this. It's literally what they're saying. It's just constant fighting. They're just like, oh, it's the Democrats. Oh, it's the Republicans. You can say this is coincidence, but they released this on the same day of the third Trump indictment. So,
You know what this reminds me of is that meme of Spider-Man where it's like,
yeah.
he's doing like the standoff
Yeah.
with himself. Yeah, that's pretty much the U.S. Congress on everything.
Mm-hmm.
So now we're
And
paying the price for it, but we could potentially profit from it. That's what we want to talk about.
we will profit from it. And we're going to show you. This is part of what Fitch is saying. The company is essentially, our deficit and what we bring in is horrible. So what we spend versus what we bring in per month, we're spending like $200 billion a month here. This is absolutely terrible. From what we take in from what we spend is bad. And you're thinking, well, COVID, man, right? That's fair. You would probably spend a lot in a national emergency. But just by year, right? 2020 and 2021 should be high. It was a national, worldwide thing,
Yeah.
right? 2023 should not be higher than 2022, 19, and 18 at all. Should not.
Yeah. Doesn't exist, man. Money's not real. We just
Horrible.
print numbers. Yeah, it's not real, man.
So this is fun, all right? This is 2011, the last credit downgrade, okay? This is August 2nd, when S&P came out and said, hey, the credit rating is now AA+, just like Fitch just did. You can see the reaction of the SPY. More importantly, you know what this arrow is?
No, what is that arrow?
This is when the S&P, the CEO was fired. Right
Wow.
after the credit rating.
Huh. Yeah. Okay.
Coincidence?
Did he randomly get into a car accident the next week too?
Nope, this is why. I'm not going to read all this, just the underline. But in 2011 is when they downgraded. Later, about 18 days, the U.S. government commenced an investigation into the S&P's role in the rating of several mortgage-backed securities, which played a role in the 2008 financial crisis. In order to mend its relationship with the government, the S&P asked the CEO to step down.
Yeah. Mm-hmm. Yep, that guy.
It should be noted, 5 months later, both Fitch and Moody were both like, no, it should be AA, just to be clear.
So they ultimately agreed. I mean, I remember this. I didn't realize the timing was that close to the actual downgrade, though. That's insane.
21
So,
days.
this is what you saw from a reaction. Kind of the end of the week ended up being a little bit different story. But when this came out, the 10-year yield, which is like the one that mortgages are based upon, and it's kind of like the real, important one, if you will, because it's kind of in the midterms. Went all the way from like 4% all up to 4.2%. That's a
That's
big move
massive.
for something
It's crazy.
as important as a 10-year yield. But it gave it all back on Friday. It just utterly obliterated. The reason why it got utterly obliterated is actually the jobs data that came out pretty good. That's what the next slide is here. If you want to go to that, the jobs number came out, and it was good. It wasn't blow the doors off, but the fact is we're continuing to see that despite 11 rate increases by the Federal Reserve, the economy is still growing. The economy is still humming along. It's still 2.2% GDP for like the first half of the year, still growing, adding jobs. The pace come down slightly of the job gains, yes, but it's still adding them, right? You see right there. This is like jobs added per month over the last year or so, year and a half.
I mean, it's still pretty steady. It's very surprising.
Exactly. I'm gonna go to the next slide. And this is another kind of sticky point, is that we're still seeing, kind of wage growth at this 4.4%. So that's the number, by the way. If you're renegotiating your own salary, that's what you really need, is at least a 4.4% increase in order to keep up with the market overall. This is a pretty broad swath, but that's what you're looking at. And this is something that kind of tests to how tight the labor market really is still. So this is showing the number of unemployed persons per job. All right. So we're still at the 0.6 territory, where we've been for the whole post-pandemic period almost, right?
Yeah.
Meaning that there's still almost 2-to-1 ratio of jobs to people that are looking for jobs. So there's a lot of opportunity out there.
I wonder how many of those are fake jobs, because that was a thing too. I mean, there's no way it's like 50%. That'd be way too high. So there's still an offset, but I bet it's not 2-to-1.
Yeah, it has come down a little bit. You're starting to see a slight increase there. It's been kind of like circulating around that territory there. But that's the real reason why this kind of came back to a baseline this week. But you saw TLT actually. I don't know if you want to go. The next slide. It got down to like 92 when the 10-year yield was up at that 4.2%.
Yeah, so
that's getting mighty tasty.
Sorry, it hit 93. 94 and change. Now, the big thing here is, can you see my mouse? Perfect. This does not react like a stock. There's the resistance lines. Now, okay, this is a little bit weird. This is correlated to a 20-year treasury. So it does react for resistance like stocks do, but the prices don't mean anything. It's correlated with the correlated yield of whatever that percent is. But if you look at it as a whole, it actually does still kind of work. So these two, this is just because it's kind of messy. This is more of a range. This is a big resistance for it to get back over, basically 98.50 to 100. And this level here is where I'm trying to buy. Now, I have 50K set aside for this. I've just been waiting. I've just been collecting interest on it. I'm going to buy some most likely this week. I'm hoping that we don't gap up. If we gap up, I'm going to hold off, because we still likely have one more rate hike. It's likely, not certain, but likely. I did sell covered calls right above this level doing my wheel strategy, and it's been working.
Nice.
So.
Yeah. Can you zoom out just to kind of give people a perspective of how far off traditional TLT levels we are? We haven't seen prices down in this like 90 territory for a long time before this.
It's a picture, not the graph.
Yeah, it's all good. It was at 150, I want to say, at the peak of the pandemic, to give you an idea of how far we are off from that. I want to say the last time we were in this like 90 something territory, before this most recent phase. Yeah, it was like 2016 or something like that. This is
almost 10 years ago. Yeah. We have not been this low. This is a chance to almost not, probably not double, but have like at least a 50% return over the course of 2 years. It's just logic. This is not a sexy trade, so people are not going to talk about it. You're not putting a bunch of money on a startup company being like, oh, it's going to 10x, okay? What you're doing is you're just using logic of, hey, we're at a rate that is not sustainable, interest rates that are not sustainable, right? We cannot be here forever. They have to lower. Therefore, TLT has to increase. That's all it is. That's how I shorted from 130 to 100, because Jerome Powell's like, we have like 5 more hikes. So therefore, it has to go down. So
Yeah.
it's not a sexy trade. A lot of people won't talk about it, but it makes you money.
Exactly. All right, guys. Let us know what you think about this in the comments down below. We'd love to hear your thoughts.
Later.